Depressions are dreadful. It may seem as though no aspect of your life is safe, given the increased chance of job losses, business failures, stock market crashes, and declines in house values. Recessions, however, can give a chance for individuals who view things in the long term. You can position yourself to profit more after the dust settles by purchasing investments in companies at a bargain. But the question is, can you really make money during a recession? Well, that's why we are here. There is no law requiring you to endure hardship during economic downturns. If you want to succeed while everyone else is seeing the sky falling, pay attention to our steps. Step 1 to making money during a recession is to protect your source of income securely. No matter how shrewd an investor you are, it won't matter if you lose your main source of income. Your sole focus will be on obtaining a new employment in order to safeguard your personal finances, as you won't have any extra cash to invest. Protecting your job, or, if you're self-employed, your business, should be your top priority. How financially secure is your company or employer? How secure is your position? Some occupations are more recession-resistant than others. Take precautions if you have any reservations about your career or small business surviving a recession. This could imply shifting jobs within the same industry or changing occupations entirely. Get a new career qualification or degree if necessary to make a proactive change while you still have a solid paycheck. You can also protect your income by diversifying it. You may, for example, create a side hustle to lessen your reliance on your day job. Alternatively, you may start a side hustle to see if it can someday replace your 9-to-5 job. There are numerous side business opportunities available to you right now. Our second step on making money during a recession is to boost your savings. During a recession, you are more likely to encounter a personal financial crisis. That implies you should plan ahead of time by increasing your savings rate to supplement your emergency fund and savings account. Examine your recurrent expenses, such as your mortgage, auto payments, and insurance premiums. Examine your credit card and bank statements for every subscription service. Reduce the number of meals prepared by others. This covers restaurant meals, delivery, takeaway, and non-packaged lunches. Look into strategies to save money on food. Food is the third largest expense for the majority of households. However, because your home payment is your largest structural expense, put forth particular effort to reduce or eliminate it. The third step could be offending and defending both your short and long-term investment plan. You don't want to lose money on your short-term investments as a result of the recession. After all, short-term investments are often intended to provide a safe way to make a modest return while parking your money for less than a year. Conduct some study on recession-proof assets for any funds you may require in the next year or two. If you see dangerous assets among your short-term holdings, sell them now and relocate your money to safer havens. Among these are precious metals, consumer staples, and dividend equities with high cash flow, to name a few. Your long-term investments, on the other hand, are a different matter. You want to look for assets that fall the greatest during recessions in order to potentially buy them at a substantial discount. Just be sure you buy assets that will recover rather than disappear in the long run. The next step is to buy heavily discounted stocks. Stocks nearly always decline sharply during recessions. You may fret about it and wring your hands. Alternatively, you may think of the stock market as being on sale. Stock markets typically decline in the 6 months prior to a recession, and during one, the S&P 500 has historically returned an average of 16% in the 12 months that follow. Additionally, from its start, it has generated a yearly return of about 10% on average. Investing in large-cap U.S. stock exchange-traded funds, such as those that mimic the S&P 500, is the most secure course of action here. More often than established, cash-flowing blue-chip businesses, tech stocks, growth stocks, and small-cap stocks experience declines. In other words, you can get a bigger discount on them. Instead of buying individual stocks, invest in exchange-traded funds that are focused on these kinds of equities to spread your risk across many different businesses. You may, for instance, invest in a fund that tracks the Russell 2000 for small-cap stocks or an index fund that tracks the Nasdaq for exposure to the tech sector. Of course, the biggest upside potential comes from selecting stocks that have plummeted in value and are primed for a significant post-recession recovery. Individual equities, on the other hand, carry significantly greater risk because any one company can fail. If you're a seasoned investor, just choose individual stocks and managed mutual funds. Our next step is to create passive income streams. It helps to generate more streams of active income during recessions, as well as more passive income. You can pay your living expenditures with enough passive income, and your day job becomes optional. It's called financial independence. And once you achieve it, you won't have to worry about little matters like losing your job. Financial freedom has a plethora of other advantages. You can pursue your ideal job no matter how good it pays. You are no longer required to pay for expenses such as life insurance or long-term disability insurance. And you may migrate any place in the globe, even low-cost places where $2,000 per month will get you by. The next step is to take advantage of lower interest rate. When a recession occurs, the Federal Reserve usually reduces interest rates in order to stimulate the economy. This makes it simpler for businesses to borrow, stay in business, and, ideally, begin growing again. However, it also makes borrowing less expensive for you. You may be able to minimize your monthly payment by refinancing your home. If you've been considering purchasing a home, you can do so with low-interest financing when interest rates fall. Low interest rates can make it inexpensive to borrow for investment purposes, such as purchasing rental homes. Our next step is to keep buying investment properties. Real estate prices might fall during a recession. Housing markets do not fall as precipitously as stock markets, but you can typically get a terrific deal during a recession. This could involve purchasing foreclosures, which tend to grow during recessions, or fixer-uppers that the seller does not have the funds to restore. While housing values may fall during a recession, rentals do not. At worst, they stabilize for a while. Lower prices and consistent rentals mean that you can earn more cash flow from investment properties than usual. When done correctly, rental property investing can assist you in creating passive income streams. Simply understand how to invest first, as novice rental property owners tend to lose money. Non-mortgage fees such as property taxes, insurance, vacancies, repairs, maintenance, property management charges, accounting, and legal costs cause most owners to lose 50% of their rent. This is known as the 50% rule in the industry, and it results in naive amateurs losing money on properties rather than gaining it. The next step is to be buying businesses at a discount. During a recession, the value of public enterprises falls, but so does the worth of tiny private businesses. If you've always wanted to own your own business, but loathe the idea of starting from scratch, you can sometimes buy operating enterprises at great discounts during recessions. Owners may just grow tired of running them or reach retirement age. In either case, when the economy fails, you can get better deals. Indeed, recessions provide a glimpse into the worst-case scenario for how diverse businesses operate under difficult economic conditions. You don't have to worry if a company will withstand a slump because you can see it in their financial statements. Just be cautious while looking for inexpensive enterprises during recessions. The last thing you want to do is purchase a failing business and pay for the sellers. Last word on making money during recession. Be fearful when others are greedy, and greedy when others are fearful. As Warren Buffett famously says, during economic downturns, most people panic, selling stocks, selling real estate, and gnawing their fingernails to the quick. That makes this an excellent moment to do the polar opposite. Maintain your cool, continue to invest, and look for discounts. Most importantly, safeguard your revenue sources, because without them, you won't be able to take advantage of the fire sale going on all around you. Please be honest to like and subscribe for more content like this.